Hello, hello, hello. Yes, welcome to another episode of the Level Up Financial Education podcast. This is our second episode, and we are officially on camera. I want to say back on camera because we've been on camera before, Jax.
Yeah.
It's been a little while though, maybe a few years now, but we're on camera here as well, so our listeners could I guess hear us on audio but also see us visually, and whether that's Spotify and of course on YouTube as well. But yeah, just a massive shout out to you, Jax. How are you today?
Yeah, Peter, I'm doing well, man. Doing very well. This month, July, as people will know, is my birthday month. So,
Come on.
yeah, just a week ago. So we're recording this a week after my birthday barbecue, my annual birthday barbecue, which you was attending, and all my friends and family. So yeah, I had such an amazing time. I've really enjoyed the summer. Yeah.
It's been a good season. It's been a good season. Shout out to you. Give God thanks for another year added to your life, man. And one other thing we're thankful for is, of course, our ongoing support, our supporters, people that have just been listening to us from recently, but also just as importantly, or even more importantly, to be honest, from the beginning, 6, 7 years ago as well. You followed us on this journey, so we give you, yeah, just a massive shout out right now. And yeah, gratitude. We're very grateful for you. But for this episode, and it's a bit of a special episode because it's our first video episode we're doing as in with our new name. So for a reminder, for maybe listeners just tuning in, we used to be, as of about a month ago, used to be called Woke Finance. So many of you know us as that, but now we are officially called Level Up Financial Education. Jax, I mean, how are you getting used to? It's been all nearly 7 years of Woke Finance. How are you getting used to the new brand and stuff?
Yeah, bro. Honestly, I still call it work finance every so often, and then I have to correct myself.
Likewise.
So I don't necessarily use the whole name of the organization, which is Level Up Financial Education
Hmm.
CIC, which stands for Community Interest Company. I just call it Level Up Financial.
Hmm.
And it's actually quite easy for me to do that because it's quite similar to my personal brand, which is Jack's Financial.
Mm,
So
mm.
yeah, Jack's Financial, Level Up Financial is starting to roll off the tongue quite easily now.
Nice. Nice. Level up financial, man. That's for our listeners out there all over the world. But listen, we're not going to keep you all too long. This episode is essentially me and Jack. We've had our own separate personal finance journey. And I mean, when I catch up with Jack from time to time about this, it sparked off in different ways, I guess. And yeah, it's been a little while now. It's been pretty much a decade. So what we are going to be doing on this episode is actually reflecting on our 10 years experience and almost going through what we've learned from 10 years of investing. So hopefully this will be quite a nice sit back and listen episode for our listeners. But Jats, what I am going to kick off with actually, as I mentioned, it'll be good to understand what originally inspired you to start investing in the first place.
Yeah, I think for me, we probably have to go back to little old Jack's finishing university. So you would
Mm,
know, people will know that I graduated with a degree in economics, and then I went on to do a master's in financial economics because that was what the I was really interested in, that kind of area
mm,
of economics. And so from an academia standpoint, I had been introduced to the financial markets, very new. So I didn't grow up knowing anything about stock markets and anything like this. So I was just learning it
mm,
from an academia standpoint to pass some exams and get a degree, right? So that was my first introduction, and then kind of my second introduction was actually working in the industry of investment management. So for, we're going from learning it from an academic standpoint to actually doing it as a job for clients and working as an administrator initially. And Peter, there was a time where one of my roles as a investment assistant at the time was to basically look through our clients' portfolios. And most of our clients had a capital portfolio and an income portfolio, which means they had a portfolio that was kind of there to grow over time, but they also had a separate sub portfolio called an income portfolio. And every month was my job to make sure that there was enough income in that income portfolio to pay out to the client. So it was my first introduction to the point where actually you don't always have to work for money. You can actually derive what now they will call passive income. Now that's what they call it, right? But you can actually generate an income from your investments. And I was like, well, that's very interesting. I had never known that that was a thing. And so that was almost like my second introduction into the financial markets. And after a while, I was like, you know what? If I'm going to be a good investment manager, because that was the career path that I was pursuing, then not only do I need to know it from an academic standpoint, not only do I need to do it just as a job, but I need to get dip my toe in. I need to be an investor myself, and that was kind of my first driving force into wanting to be a retail investor myself. Yeah, which saying it back out loud is strange because I would have thought that I wanted to invest because I wanted to build wealth and be financially free. But actually, looking back, my initial driving force was the fact that I was doing it professionally and I wanted to become a better investor for other people.
It's interesting because yeah, when you look back over the years and trying to pinpoint what's that moment that kind of sparked something for one to start investing. And I think for me, it was a series of events over in my life. But I'll say where it started to really speed up a bit was in my younger days, probably towards ending university and then just coming out of university. I was quite what you would call back then quite entrepreneurial in the sense of I was getting my hands involved in different things. I mean, I wasn't from a nominal perspective, I wasn't making much money from it, but I was just getting involved in different ideas. I even set up a little small business, first time getting something registered, even doing all of those things, and just learning about how to add value to, I guess, to the world essentially. Um, and I think that really sparked a few things. And as a result of that, I was reading quite a lot. Even when I'll go to my day job, it'll be about an hour journey to get on the train to get to my day job at the time, and I'll spend pretty much all of that hour just reading books. I wasn't much of a fiction reader; it was all non-fiction, so-called self-help books, some of the cheesy self-help books, and then some of the well-known self-development books as well, from your, Rich Dad, Poor Dad. But even it wasn't just about business and money. There was other things. I mean, I read all the books like starting with Why when I was a bit older. And we've got a session actually called The Power of Reading. I can't remember what episode it is, but I definitely encourage our listeners to go to that episode. It was a very popular one where it talks about where me and Jax share all of the books that we've read on our journey. Yeah, and I think that sparked a few things. As I said, I read things like Rich Dad Poor Dad, but one of the books that I read, and I didn't know what I was reading at the time, but it was by a book, maybe because he has my name, but it was by a book called Learn to Earn by someone called Peter Lynch.
Yes, I've read it too.
Um,
Yeah.
and don't ask me how the book was around. It was just there. I can't even explain to you. But yeah, I read that book, and I remember when I was reading that book. I didn't really understand what I read, but I remember getting from that is that the average person can invest in things that are around them.
Yes.
That's what I got. I'm not saying that's what we should do now, but it just opened my eyes. Wait, the average person, and I am the average person. When I used to hear of things like stocks and shares, I genuinely thought it just wasn't for me.
Yeah.
And at the same time, that also became the birth of some investment platforms that kind of, made it more accessible to maybe someone like me who had no idea, or I didn't know anyone that was investing or never spoke to me about investing. So yeah, I'll say it was the books married with me being entrepreneurial and just hearing different things from different people. And then I
Yeah.
started to get the belief that I can actually go in and try. And we'll talk about some of the mistakes we made. I'm happy I made those mistakes because they were
Yeah.
very silly when I look back. But it was that belief and everything going on that actually made me want to do that.
Yeah, no, Peter, I can echo some of those things. I mean, as I said, my driving force initially was my academic and professional background,
Mm,
but actually, the moment I started dipping my toe into investing, it kind of, we could call it open a can of worms. I really went down the
that's
rabbit
it.
hole
Rabbit
of,
hole, yeah.
yeah, of really wanted to learn more, not just as a professional investor, now, but as a retail investor. So yes, Peter Lynch is one of those people that I read. I read three of his books. So
Mm,
Learn to Earn, I believe, is one of the first books. Then he had One Up on Wall Street, and also Beating the Street, which is quite similar to One Up on Wall
yes,
Street. Yeah.
yes,
So Peter
popular.
Lynch, I remember reading all three books and really being excited about investing and knowing what you own, that kind of phrase, and stuff like
Yes.
that. So yeah, and as you said, books like Rich Dad Poor Dad. I mean, we look back now and we notice that maybe some of the ideologies we may not completely agree with, but
Hmm.
I do want to give the book its flowers,
Mm.
in terms of kind of getting you into a mindset of actually building a portfolio or investing in assets and not
Mm.
just relying on active income. So yeah, the moment I kind of dipped my toe in, the kind of worms are open, and it was deep into the rabbit hole of reading books. But also even back then, probably more 2018, which is about 8 years ago, I started actually listening to podcasts.
Yeah. Yeah.
So this was before podcasting really became a big thing. I had a few
Mm.
podcasts that I would listen to on my way to work. Just put the headphones in on the bus on the way to work because I was lucky, I'm fortunate enough to be able to take one bus straight to work.
Yeah.
So yeah, that's kind of what got me in, and it's been an exciting journey so far.
No, absolutely. Shout out all the old school podcasts out there and YouTubers, as well, certain YouTubers, which we can talk a bit about that. But I mean, going down that rabbit hole, often does lead to mistakes as well, and we can talk a bit about some of the mistakes we've made over the years as well. But it'll be good to understand actually, Jax, from you. I guess, you spoke about Rich Dad Poor Dad, for example. And it's very easy for someone to just pick up a book and then run with it and say, I'm gonna do everything this book has told me. But on that, in terms of sort of ideas and thoughts about investing, what would you are some of the things that you feel has developed or shifted or changed in terms of mindsets now since, I mean, over the years since you've begun investing?
Yeah, I mean, my ideologies about investing has changed quite
Mm,
drastically, I would say. Not There's still some principles that are timeless. But back
mm.
then, after reading these books, I thought I was going to be the next Warren Buffett. I thought I was going to be able to pick a concentrated portfolio and outperform the
Hmm.
market because such is my ego, such
Yeah.
is my arrogance.
Trust me. Yeah. Everyone feels like that, man.
Yeah,
Everyone goes through that point. Yeah.
yeah, absolutely. So, yeah, and ultimately, it's kind of as I got older and experienced life a bit more, kind of thinking about investing more from a solutions provider standpoint. That's kind of something I've changed. And what I mean by that
Mm,
is, historically, all I wanted to do was pick assets that were going to go up in value, producing income, and it was all about just outperforming the market. Right? That was the goal,
mm,
to build
mm,
wealth and just make as much money as possible. But after 10 years in the industry of investment management as well, I've been in the industry for 12 years. But as a retail investor for 10 years, I think I've noticed that actually, and the way I invest now is I build portfolios to meet specific goals. And so it's not necessarily about just picking stocks and hoping that they do well, but it's choosing a portfolio and earmarking that portfolio for a long-term goal. And
mm.
what that looks like, for example, is if I want to retire comfortably in the next few decades, then there is a portfolio specifically designed to meet that goal according to my objective and risk tolerance. And then if I've got a
Absolutely.
portfolio that's more medium term and I want to use it to buy a property in the next 7 years, then there's a portfolio earmarked to achieve that goal, and it will have a different risk to return profile because it has a different time frame. So that's kind of what's really drastically changed as to what I used to do when I first joined and thought I was going to be the next Warren Buffett and tried to read The Intelligent Investor, which I still haven't finished reading. Very difficult book to read.
Yeah.
Um, now
Ah,
it's
yes,
more
of course. I remember reading that. Yeah.
now it's more about, okay, let's design portfolios, let's create these bespoke portfolios that are specific, that are accompanied with what we call an investment policy statement, which is I have a written almost governance structure that tells me how this portfolio is supposed to be run, and those portfolios are earmarked for long-term goals. But then, I can't help myself. I really can't help myself. I still love the world of investing and stock picking. So
Mm,
what I then do is I've created another portfolio, which I call it my opportunities portfolio or my risk capital portfolio. where I am allowed to pick individual stocks and
Mm,
hold them for the long term. But those are almost like we could call them bets and things that I hope can do really well, but they are completely separate from my portfolio solutions and vehicles that are designed to meet long term goals. And look, Peter, when we first started investing, well, 10 years ago, I was a single man living in my parents' house.
mm,
Fast
mm,
forward a decade, I am now a married man
mm,
with a mortgage and hopefully building a family in the
mm,
future. So that my life
yeah.
stage has also changed, and now that I'm older and wiser, my
Mm.
portfolios and how I invest has also changed.
And I love that, Jats, because very easily you could be talking to maybe a younger person and you might say, I don't know, you've got this portfolio with these holdings and these stocks or funds or whatever it is. And the young person might be hearing that thinking, whoa, I'm gonna copy that. Or whoa, that sounds a bit strange. Why doesn't he have these types of holdings and stuff? But you have it for a particular purpose that is personal to where you are going in your journey. And that's why it's so important we talk about personal finance being personal. Even we can go on YouTube and listen to someone say, "Hey, I'm put my money in this, put my money in that," and because you maybe respect them, you would want to copy. But again, and so that's why it's so important that you shared that just now, actually.
Yeah, yeah, and people will know that I work as a financial planner at the moment. So,
Hmm.
doing it professionally, I think it's very important that we understand that often portfolios are supposed to fit a holistic financial plan, and you don't
Mm,
know what that person you're watching on YouTube or the person down the pub or why they've picked a certain stock or how their
mm,
income and expenses look like. You may not generate as
mm,
much what they call free cash flow. You might not generate as much income as that person to be able to take the bets that they're taking. So your risk
yeah.
profile and your risk capacity for loss and stuff like that will be completely different. So you can't just
Mm,
go and copy someone, hoping that you get the same returns. Because guess what? They also won't tell you when they've sold. And
mm.
if they
And they don't
do,
have to.
and
Yeah,
they don't
yeah,
have
yeah.
absolutely no obligation.
Mm,
They're not regulated, so they have
mm,
no reason to tell you why they've decided to sell this stock. Yeah, so you can be left
yeah.
hanging, really.
Yeah. Beyond that, on the I guess theme of listening to people, there are some obviously OGs out there. So the stock market's been around for about, well, technically for about 400 years or so. There's a particular OG that has been around for almost a fourth of that, and that's Mr. Warren Buffett and
Yeah.
obviously the late Charlie Munger as well. And they've had pearls of wisdom to share over the decades as well. How do we go about navigating that? Because as I said, how I first started was actually reading from some of the OGs in the game as well. So how can one go about navigating that?
Yeah, look, I think when we listen to people like Warren Buffett, Peter Lynch, Charlie Munger, and there's many other very successful investors historically, I think you can definitely learn from some of their timeless principles.
Mm,
So I think Warren Buffett has some really, really good principles that almost everybody repeats and they are
hmm.
timeless and you can use those to govern how you're going to invest over the long term. But I also want to be very clear that investors like Warren Buffett and so on and so forth, they are managing money for other people. They
Mm,
have
mm.
a much wider pool of capital to invest.
How
Their
much?
principles are different.
Yeah.
Warren Buffett can't even invest in, or Berkshire Hathaway, which is actually the portfolio that they manage. It can't invest in certain stocks because of the size, because then they would have to
Mm,
take a majority stake and that causes issues, and they would not want to do that. So I wouldn't, in my opinion anyway, I wouldn't just copy their investments because again, all investments have a objective time frame risk appetite that might be completely different from yours.
mm,
I'll be more focused on some of their more timeless principles and using them as a guiding principle to follow. For example, timing the market
mm,
is better than trying to time the market, and all these different phrases. These
mm.
are timeless and will definitely help you going forward.
Yeah, no, absolutely. I think for me, Jackson, you probably relate to this. One of the shifts or mindsets or thing I've had to develop over the years is probably what I'll call emotional stability. So I'll say, I mean, over the now where I am now, like the news. and media and what you might hear on, I don't know if it's social media, whatever it is, it doesn't really impact me as maybe as much as maybe my earlier days in the first 3 to 5 years or so when it comes to investing. I'm so relaxed in terms of I already know next year, could be next month, there will be reports of the next biggest crash. There will be reports of, oh, this particular market is going to go down because this is happening. There's war over here. There's Listen, this is just part and parcel of the life. So it doesn't really impact me. I can't remember the last time I've ever felt worried about something in terms of should I sell or should I empty my bank, my cash balance to buy into this particular thing or anything like that. So
Yeah.
yeah, I'll definitely say over the years I've developed or yeah, just my emotional strength when it comes to investing. It's really not that deep from that aspect. And I've become what you might call a boring, real-time, long-term investor.
Yeah. Well, I think, if you talk about my biggest learning, probably I would say as an investor, both retail and professionally, why people get it wrong, particularly retail investors, I would say it
Mm,
really comes down to behavior. It really comes down to behavior.
mm,
Well, two things. I'll say it comes down to behavior and it also comes down to not actually having a plan in the first place, right?
mm,
I've spoken about things in the past when we talk about behavioral biases, where we talk about our emotional biases, and then we talked about our cognitive errors, and these being the things that often causes us to make irrational decisions. And I think
mm,
over time I've been able to pinpoint in my own investment career, as a retail investor, where I have been subject to an emotional bias.
mm,
For example, loss aversion is something that I have struggled with. Loss aversion is a very common emotional bias where we feel the pain of loss, more than we value the the gain, right? So if I lost £100, that would hurt me much more than if I made £100 in terms of how satisfied I would be. And that
yeah.
causes people to make irrational decisions. That causes us to hold on to stocks for too long, hoping that they just bounce back up, for
Mm,
example, and all these things.
mm,
So if we do become more sturdy in our kind of like management of emotions, that makes us significantly better investors. But another way to
mm,
think about that is actually to create a portfolio that meets that emotional, how you
yep.
respond emotionally, right? So maybe you may need to have a portfolio that's less volatile. Maybe you need to do what I mentioned earlier. Have your portfolios that are earmarked for specific goals, and then have your risk capital where you can
Mm,
almost take bets and experience high volatility and not panic because you know that you've actually
yeah.
already designed other portfolios to meet your long term goals.
I was going to say on the back of that, is it a fair question or a statement to say, if you do find yourself constantly in fear and panic mode, ready to press the button for whatever action that leads to, can one question your actual overall portfolio, if that makes sense?
Yeah, yeah, absolutely. The amount of people I've spoken to, for example, that have just invested in the S&P 500,
Hmm.
and then I go on an exercise with them to ask them what is their risk tolerance or risk
Mm,
profile between 1 and 7, 7 being the most risky and 1 being the least risky, and then they'll say something like 3. And I'll say,
mm,
well, investing in an all equity portfolio like the S&P 500 is
definitely quite
5 out of
high.
6 out of 7.
Yeah,
So
yeah,
you
yeah,
clearly
yeah.
haven't invested according to your risk appetite or
Yeah,
risk tolerance. So yeah, and that comes with a bit of education as well, just
of
understanding
course.
risk
Yeah,
and that kind of stuff. So yeah, a lot of people, that is the problem. Ultimately, that is a
yeah,
problem. The
yeah,
experience is a great help in terms of becoming more attuned with risk and understanding risk, and because we've gone through, I mean, 10
yeah,
years we've gone through
yeah.
the lockdown,
COVID.
we've gone through 2018 the market crash, we've gone
Yeah,
through the almost extremely high inflation, stagflation in
yeah,
2022.
yeah,
We've gone
yeah.
through these and we've kind of built that resilience through
Hmm.
experience, but not everybody has. And that's really important. It's really
Hmm.
important to understand. And not to
Very
lie to
true.
yourself, everyone is a long
Mm.
term, investor. Everyone could take risk when the stock market is going up. It's only when the market goes down, as Warren Buffett would say, one of the principles is when the tide goes down, you see who was swimming naked. So,
I always laugh when they hear that because I literally imagine it. I literally imagine it. That's funny.
yeah,
But even on the back of that, man, and I haven't got you too long as well. We are going to wrap up shortly. But even on the back of that, you mentioned some of the mistakes that you've seen, and of course that we've experienced. Do you want to maybe highlight a couple of mistakes that? Yeah, you've made along the way a couple because there'll be
Yeah,
many vice
we've made
versa. Yeah.
countless mistakes, coupled by some good decisions. But the mistakes
Yeah.
I think about straight away was allowing my animal spirits, and
Mm,
I'll explain what that is, to govern how I was investing and how I was going in and out of stocks. So animal
mm,
spirits are greed and fear; those are the two main ones.
okay. Yeah.
So getting really excited when the stock market is going up and investing in a bit more, and then getting scared on the downside, right? And then maybe selling a bit too early. Those are probably the mistakes that most people make, but I've made those mistakes myself. Um, Two of the ones that are quite well known by my friends have been basically not holding stocks for long enough and selling because of outside influence or so on and so forth. For example, we talk about Tesla. I held Tesla pre lockdowns, and I think it's 20x since then.
Hmm.
But I had sold for maybe a 20% return, right? So I've lost out on thousands of percents of returns because I was influenced by someone outside who told me that the stock was too risky. It also shows that I probably didn't do my due diligence early enough
I
to
about to say,
understand the
yeah.
risks attached to that stock, which
Hmm.
then caused me to make what is an irrational decision, right?
Hmm.
Similar to Nvidia, I also heard Nvidia
Hmm.
pre lockdowns as well, which we all know what Nvidia's done. It's become at this point one of the largest companies in the world.
Yeah.
So yeah, just investing in stocks because I like the theme and I think it's going to do well, but they're not really understanding the risks attached. So much so that whenever someone has kind of challenged
Mm,
my investment, it has caused me to sell,
mm,
albeit at small profit, but that's nowhere close to where it could have been, right?
yeah.
And then the last one is actually holding on stocks for a bit too long. So there was a
Mm,
particular stock that I held called a tattooed chef
mm.
during again during the lockdowns, which
Lockdown says.
yeah, the company did show signs of weakness and signs
Hmm.
of things that I should have been concerned with. But
Hmm.
again, going back down to that loss aversion, of not wanting to sell at a loss, I literally watched the stock go down and down and down, and ultimately went bankrupt. So that
Mm,
was a learning curve as well. Which is when you pick stocks, you have to actually spend a lot of time following the business. You can't just pick stocks and lock them in a cabinet and hope that they're going to do well, especially when you've invested a decent amount of money into it. So that was a learning curve, and that was a
mm,
mistake that I've made, and which is why when I talk about investing now, after 10 years of experience, I talk about creating portfolios, diversifying, making sure those portfolios are designed to meet your life stage goals. And then if you want to invest in individual stocks, then have a separate portfolio, risk capital, and you can invest in individual stocks. But you have to be willing to follow those companies to make sure that they're doing what you think they're going to do.
mm. And on the back of that, I'll definitely say similar to the last point, around getting excited when new things are coming up. So, for example, our listeners will be aware in the last maybe 6 weeks of a particular IPO. You mentioned Tesla, but Elon Musk's SpaceX, for example. Now, I think had this been maybe 7, 8 years ago, how I would have responded to that to how I responded now would be completely different. And it's not even to say whether I'll buy it or not. It's about if I did want to make a decision to buy it, I know exactly the risk associated with it. I know what portfolio I'm putting in for what purpose. Obviously, that will be in something that is, a small percentage of my overall portfolio, and maybe in a portfolio that I've designated to. I mean, you called it bets portfolio. I call it sort of a fun portfolio, or something where I actually don't mind seeing whatever happens, and it's a very small chunk. But also this time 8 years ago, I would have just got gas because everyone else was talking about it. They were making they said it was the biggest ever IPO, whatever. They were doing everything they can to get hungry investors involved. But now that does not faze me. If it's a company that I couldn't care less about, if it doesn't fit, I already have my financial plan. I know what I'm trying to achieve.
Yeah.
I'm satisfied with my current portfolio. So I now, for me, in my personal life, I know what an opportunity actually looks like. And
Yes.
it's not just following big
Vibes.
news.
Yeah. Yeah.
If I'm being honest between me and you, I'm very happy with and for a lot of people they might not be down with this, which is absolutely fine. But I'm very happy in looking at a company. I'm not, by the way, but in looking at a company like SpaceX and saying, Oh, that sounds interesting. I'm actually okay with just seeing how it performs over the next 5 years
Yeah,
and not
you're
touching it. I'll look at the earnings. I'll see if there's progressive growth to reaching profitability because when these companies IPO, they need your money, and a lot of them do not make it out past that stage. It's
yeah,
got popularity, but is it reaching profitability? Is what it's doing fits in with my moral compass as well.
yeah,
In terms of what it's trying to achieve, all of that stuff. And I will happily watch that company in the next 5 years. And if I generally feel there's an opportunity, okay. If I say, okay, I'm going to watch a little longer, I don't mind. I won't, I'm not those people that would be like, oh, I actually should have went in it 5 years ago.
yeah.
Because
So
everyone could always do that.
what you're saying is you've managed to deal with some of these behavioral biases. One of those is regret bias. Another one is avoiding the herd mentality or the fear of missing out as well. So that
Simple.
that's
Yeah.
what investing is all about. It's
Hmm.
picking individual companies. It's not that hard. Investing is
Yeah.
I don't think it's that hard because of the information we have now. Is being able to manage those behaviors.
Absolutely. And
Cool.
that's what I would have definitely, and that's what I had done back in the days. I bought a number of
Oh yeah,
IPOs
we've
and
done this.
other companies people were making noise about all of that. So
Yeah.
yeah, and the only other one I'll say, it's very basic, but it was in the earlier days when I was investing, I never actually took full advantage of tax efficient wrappers.
Yes.
I wasn't mindful of the investment platforms I was using. I was just literally doing what I was doing.
Which is a
So
mistake a lot
no.
of people make. It's a mistake that a lot of people make, just buying stocks in a standard account and not understanding there's tax implications of that. And yeah, here in the UK, we've got stocks and shares ISAs. In America, we've
Hmm.
got Roth IRAs, 401ks, and you probably want to prioritize those first, which goes back to what I was saying before. All these investments that we do should form part of a financial plan first,
Absolutely.
and then we can actually start deciding how we're going to implement that. But Peter, time has been
Absolutely.
fast spent, and
Time has been fast.
we're
So
gonna have to do
yeah,
a
and
part
yeah,
two. We're gonna have to do a
we are
part
gonna
two.
have to. We are gonna have to. I'm gonna have to let you go. I'm gonna ask one final thing before I let you go. I won't answer, but I'll ask you. How would you invest differently over the next, or similarly over the next 10 years?
I think I've already answered it, Peter. I
Hmm.
think the key thing over the next decade now is to actually have a plan, an investment policy statement for what my goals are. Making sure that each portfolio is designed to meet a goal. And also reviewing it maybe once a year.
Hmm.
So not watching the stock market go up and down and stuff like that, and making changes and being too having those knee jerk reactions. And also when I pick individual stocks, being happy to hold them for 10 years. So you can hold me accountable. All the stocks that I hold in my portfolio right now, 10 years from now, when we do another episode, who ask me if I still hold those stocks, and if I don't, why not?
Listen, we'll make that happen, man. We'll make that happen. Thank you very much, Jax, as always, for our listeners, and we will continue this discussion. We thank you for your ongoing support. And remember, keep leveling up, man. Until the next time.